In every economy throughout history, governments have had one extraordinary power: the power to create more money. Empires used it to fund wars. Nations used it to fight recessions. Central banks still use it today to influence the global economy. But in 2009, someone introduced an entirely different idea. What if money could never be printed beyond a fixed limit? Not because a government promised restraint, but because the software simply refused to create more. Hidden inside Bitcoin's code was a rule that most people barely noticed. Every 210,000 blocks, the number of new Bitcoins entering circulation would be cut in half. No debates, no emergency meetings, no politicians, no central bank, just mathematics. Today, that simple rule is known as Bitcoin Halving. It has quietly shaped every major chapter of Bitcoin's history, influencing miners, investors, institutions, and even the psychology of global markets. But why would intentionally creating fewer coins make Bitcoin stronger? To answer that question, we need to go back to the very beginning. Gold became valuable because nature made it scarce. Bitcoin became revolutionary because mathematics made its scarcity inevitable. When Satoshi Nakamoto released Bitcoin in January 2009, the world was still struggling to recover from the global financial crisis. Banks had failed. Governments were printing unprecedented amounts of money. Confidence in the traditional financial system had been shaken. Bitcoin offered something radically different. Instead of relying on trust, it relied on code. Every 10 minutes, miners around the world competed to solve complex mathematical puzzles. The first miner to solve the puzzle earned newly created Bitcoins as a reward. In the beginning, that reward was 50 Bitcoin for every block. At first glance, it seemed like an ordinary mining incentive. But hidden behind it was one of the most elegant monetary policies ever designed. Unlike gold, whose future supply depends on future discoveries, Bitcoin's future supply was already known. Every participant on Earth could calculate exactly how many Bitcoins would ever exist. Not approximately, not politically, exactly. 21 million. Nothing more, nothing less. To protect that limit, Satoshi introduced another rule: every 210,000 blocks. The mining reward would automatically be reduced by 50%. No one could vote to change it. No government could delay it. No company could suspend it. The network would simply continue following the same instructions it had followed since the first block. For the first time in history, scarcity wasn't enforced by nature. It was enforced by mathematics. At the time, almost nobody imagined how powerful that idea would become. Bitcoin itself was worth only a few cents. Most people had never even heard its name, and many believed the project would disappear long before that first reduction ever arrived. But time was moving toward an event unlike anything finance had ever witnessed. The countdown had already begun, and in late 2012, Bitcoin would face its very first test of programmed scarcity. On November 28, 2012, Bitcoin reached a milestone that had been programmed into its code since the very beginning. Without fanfare, without intervention, without anyone pressing a button, the block reward dropped from 50 Bitcoin to 25 Bitcoin. It was the first Bitcoin halving. For the first time, the network proved that its monetary policy wasn't a promise. It was an automatic law. Many outside observers expected chaos. Would miners quit because they were earning only half as many coins? Would the network slow down? Would Bitcoin fail its first major economic experiment? Nothing dramatic happened. Blocks continued to be mined. Transactions continued to be confirmed. The blockchain kept moving exactly as it always had. For those paying close attention, however, something fundamental had changed. Every day, fewer new Bitcoins were entering circulation. Supply had been permanently reduced. Demand, meanwhile, continued to grow slowly as more developers, investors, and early adopters discovered Bitcoin. The change wasn't immediately reflected in the price. In fact, many people barely noticed the halving itself, but markets rarely react instantly. Major economic shifts often begin quietly before becoming impossible to ignore. Over the following months, Bitcoin's price began climbing faster than almost anyone expected. Confidence in the network grew. People realized something remarkable. Bitcoin's monetary policy wasn't controlled by human emotion. It wasn't influenced by elections. It couldn't be altered by political pressure. For the first time, a global monetary system was behaving exactly as its creator had predicted years earlier. The first halving became more than a technical event. It became proof that Bitcoin's rules could survive reality. Investors started asking an important question. If reducing new supply once produced such a powerful effect, what would happen when it happened again? 4 years later, the world would discover that the first halving wasn't an exception. It was the beginning of a pattern. By 2016, Bitcoin was no longer an obscure experiment. Thousands of businesses accepted it. Exchanges operated across the world. Millions of people now owned Bitcoin. On July 9th, 2016, the second halving arrived. The mining reward fell again, from 25 Bitcoin to 12.5 Bitcoin. This time, the world was watching. Financial media covered the event. Investors debated whether the price would explode overnight. Many expected instant results. Instead, very little happened. For weeks, Bitcoin traded within a relatively narrow range. Some critics declared that the halving theory had failed. But history repeated itself. Months later, demand accelerated. New investors entered the market. Confidence spread rapidly. By the end of 2017, Bitcoin reached nearly $20,000, becoming one of the greatest financial stories of the decade. Then came another cycle. On May 11, 2020, during a global pandemic and unprecedented monetary stimulus, Bitcoin experienced its third halving. The reward dropped again, from 12.5 Bitcoin to 6.25 Bitcoin. This time, something had changed. Institutional investors were beginning to pay attention. Public companies added Bitcoin to their balance sheets. Large investment funds entered the market. Bitcoin was no longer viewed as an experiment. It was becoming a legitimate financial asset. In the years that followed, Bitcoin reached new all-time highs once again. Then came 2024. The fourth halving reduced the reward to 3.125 Bitcoin. By now, halving had become one of the most anticipated events in global finance. But an important lesson had emerged from every previous cycle. The halving itself was never the moment prices exploded. Instead, it quietly changed the balance between new supply and growing demand. The real impact unfolded gradually, sometimes over many months. And that simple difference explains why so many people misunderstand Bitcoin's market cycles. If every halving follows a predictable schedule, why doesn't everyone simply buy Bitcoin and become rich? The answer has far less to do with mathematics and far more to do with human psychology. If Bitcoin halving is completely predictable, why doesn't everyone simply buy before it happens? On paper, the strategy sounds obvious. Every 4 years, the supply of new Bitcoin is cut in half. If demand remains the same or grows, the price should eventually rise. So why isn't becoming wealthy that simple? Because markets are driven by people, and people are driven by emotion. During every cycle, the same psychological pattern unfolds. When prices remain flat after a halving, many investors become impatient. Some begin to doubt the entire theory. Others sell because they expect nothing to happen. The market enters a period of uncertainty. But beneath the surface, something important is already changing. Every day, fewer new Bitcoins are being created. Miners have fewer coins available to sell. Meanwhile, long-term holders continue accumulating. Supply slowly tightens, yet most people don't notice. Then a catalyst appears. Perhaps a major company announces it has purchased Bitcoin. Perhaps governments begin discussing regulation. Perhaps a new ETF opens the doors for millions of investors. Suddenly, the story changes. Media attention returns. Searches for Bitcoin surge across the internet. Social media fills with predictions. News headlines attract millions of new investors. Fear transforms into excitement. Excitement becomes optimism. Optimism becomes greed. Then comes the most powerful force in every financial bubble: FOMO, the fear of missing out. People who ignored Bitcoin for years suddenly rush to buy. Friends tell friends. Families discuss it at dinner. Television covers it every day. Demand accelerates precisely when new supply has already been reduced. That combination creates explosive momentum. This is why halving should never be viewed as a magic switch. It is not a guarantee of higher prices. Instead, it quietly prepares the conditions that can amplify demand when human psychology begins to take over. The code creates scarcity. People create bull markets. But not everyone believes halving deserves the credit. Some economists argue that the entire theory is deeply flawed, and their criticisms raise important questions. Since Bitcoin's creation, critics have argued that halving is overrated. Their first argument is simple. Because everyone already knows the halving schedule, its effects should already be reflected in Bitcoin's price. Economists call this the efficient market hypothesis. If information is public, markets should price it in immediately. Others focus on miners. Every halving instantly cuts mining revenue by 50%. If Bitcoin's price fails to rise, many mining companies become less profitable. Some may even shut down. Would that weaken the network? History suggests something different. After each halving, less efficient miners often leave, but stronger miners expand. New technology improves efficiency. Hash rate eventually reaches new record highs. Bitcoin continues adapting. Another criticism concerns security. As block rewards continue shrinking, will transaction fees eventually become enough to support miners? No one knows with certainty. It remains one of Bitcoin's biggest long-term questions. Yet every previous prediction of Bitcoin's collapse has shared one characteristic. None has happened. The network has survived exchange failures, government bans, civil wars within the community, market crashes of more than 80%, and 4 halving events. Each cycle has tested Bitcoin under different economic conditions. Each time, the network continued producing blocks approximately every 10 minutes, exactly as its code intended. Perhaps the greatest lesson isn't that halving guarantees higher prices. It's that Bitcoin has repeatedly demonstrated something even more valuable: reliability. The rules haven't changed to solve short-term problems. The system simply continues operating, block after block, year after year. One day, the block reward will become so small that almost no new Bitcoin will be created. What happens then may define Bitcoin's future for the next century. Every 4 years, Bitcoin becomes a little harder to create. The reward that once stood at 50 Bitcoin per block has already fallen to 3.125 Bitcoin, and it will continue shrinking. again and again, until one day, no new Bitcoin will be issued at all. According to Bitcoin's design, that moment will arrive around the year 2140. By then, nearly all 21 million Bitcoins will already exist. For the first time in history, humanity will witness a global monetary system where the creation of new money has permanently ended. No central bank has ever operated under such a rule. No government currency has ever reached a point where its supply could never increase again. Bitcoin will. That raises an important question. If miners no longer receive newly created Bitcoin, why would they continue securing the network? The answer lies in transaction fees. Every time someone sends Bitcoin, they pay a small fee. Today, those fees represent only part of a miner's income, but over the coming decades, transaction fees are expected to replace block rewards as the primary incentive for miners. Some economists believe this transition will happen naturally as Bitcoin adoption grows. Others argue that no one can be certain how the network will evolve over the next 100 years. And they're right. No one knows exactly what the future will look like. But one thing is already certain. The rules governing Bitcoin's monetary policy have remained unchanged since January 2009. Governments have changed. Currencies have changed. Interest rates have changed. Financial crises have come and gone. Entire industries have been transformed. Yet Bitcoin has continued following the same schedule. Block after block, halving after halving, year after year. That consistency may ultimately become Bitcoin's greatest advantage, because markets don't only value scarcity, they value predictability. And few assets in history have offered a monetary policy as transparent as Bitcoin's. Whether Bitcoin becomes the foundation of a new financial system, or simply remains a unique digital asset, its halving mechanism has already rewritten the conversation about what money can be, not through promises, not through politics, but through mathematics. For thousands of years, human civilization has searched for a form of money that couldn't be manipulated. Gold came close, but even gold depends on future discoveries and increasing production. Bitcoin introduced something entirely new, a monetary system where every participant knows the rules in advance, a system where scarcity isn't protected by governments, it's protected by code. Every 4 years, the world watches as Bitcoin quietly keeps another promise. No speeches, no negotiations, no emergency decisions, just mathematics executing exactly as planned. And perhaps that's the most remarkable innovation of all. Bitcoin didn't simply invent digital money. It proved that, for the first time in history, trust in money could be replaced by verifiable rules. Because in the end, the most valuable currency isn't the one that can be created at will. It's the one whose scarcity can never be questioned.